I now hand the conference over to Anand Shah from Axis Capital. Thank you, and over to you, sir.
On behalf of Axis Capital, I welcome you all to the Page Industries Q2FY21 earnings conference call. We have with us the senior management of the team represented by Mr. Sundar Jinomal, Managing Director, Mr. Vedji Tikku, CEO, and Mr. K. Chandrasekhar, CFO. So I will just like to hand over the call to Mr. Jinomal for opening remarks. Thanks, and over to you, sir.
Thank you, Anand, and good afternoon, everyone. And thank all of you for attending this call. We have had a very heartwarming experience when the markets gradually started to open up after the series of lockdowns. Our distributors and retailers, along with the sales team, have always had tremendous respect and confidence for the Jockey brand and the Jockey business. But the message they keep sending us now is that their respect and the confidence levels have increased multifold as they witness the resilience and strength of the brand during what is possibly the worst case market scenario ever in the country. Even during this challenging market, we have continued to add retail partners across MBOs and, of course, EBOs. August was a turnaround month for us, where we just about reached last year's level of sales. September has seen double-digit growth over last year, and Q3 is looking even more encouraging. We believe that the India consumption growth story is very much intact. Our aspiration for a $1 billion top line in 5 years remains intact. As leaders by far in our categories of innerwear and athleisure, and with our strengths, financial or otherwise, we believe that as our target market continues to grow, a platform to take full advantage of this potential. So we will continue with our approach, which is to keep outperforming and outdoing ourselves in all aspects of the business, and continue to capitalize and take full advantage of all our inherent strengths. We understand that given the size of the potential market, this is a marathon and not a sprint. To make ourselves future ready, we need to continue to make investments in digital and business transformation to strengthen efficiencies, enhance automation, speed to market. Some of you will recall in past meetings we talk about Salesforce automation, warehouse management systems, distributor management systems, ARS, that auto replenishment system, and more recently assortment generators, having a separate MIS cell for sales analytics, the JBA supply chain planning tool, which is a very powerful tool, and soon business process reengineering. So all these things are going to happen, and we will continue to strengthen management as well with the best talent. And of course, we will continue to create newness, development, marketing, brand building. And in part, because of the experience during this pandemic, there is renewed focus on becoming more efficient and optimal in all aspects, in every department, while at the same time taking care to eliminate any wasteful spend or activity. I have to say that we are blessed to have an amazing team and amazing partners in the front end and the back end. That's our channel partners, our vendors, our suppliers, franchisees, and so on, who have all performed remarkably, showing their mettle during the toughest of times. From our sales team in the field who work determinedly and walk the extra mile to achieve their goals, our associates on the shop floors who work industriously and tirelessly to catch up with the demand, while having to wear, face masks and face shields. I'm proud of the great values, the culture, the passion, commitment, loyalty, and dedication ingrained in every member of our team. A culture founded on empathy and mutual respect for everyone, not just as an employee, but as a member of the family. This culture manifests itself in the kind of products that we deliver, resulting in great consumer experience, respect, and love for the brand. Thank you all again, and I now hand over to Veggie for the Q2 update.
Thank you, sir. Thank you for the opening remarks. And good evening, everyone. And let me take this opportunity to wish everybody a happy Diwali in advance. Coming to the quarter two performance, the revenues for the quarter two, though we came a long way, they grew by around 4.5%, mainly due to July being below normal. We have had a very strong sequential growth, about 160% growth in revenue from the previous quarter. This was aided by relaxation in the lockdowns across the country and an increasing propensity for online shopping. Our volumes fell short by 13.6% for the quarter as compared to Q2 of financial year 20, largely due to low volumes in the month of July. Retail partners across all channels continue to open during this quarter. Today we have more than 95% of our MBOs fully functional. 100% of our EBOs have opened now. In fact, the good news is we have opened 60 new EBOs during this quarter. And more than 90% of our large format stores have also reopened. The sales trend from June onwards is on an improving trajectory, and we are quite hopeful of a full recovery by the Q4 of this year, financial year 21. We have witnessed a good consecutive growth across all product categories and sales channels in August and September, along with the continued greater demand on the e-commerce side of the business and athleisure product as a category. Our manufacturing and warehousing facilities have returned to pre-COVID levels. As I had said in the previous earnings call, we had retained all our workers and paid full wages to them through the entire lockdown, resulting in a high attendance of more than 95% as of date. On the marketing side, our branding efforts continue across all multiple channels, including online, media, and point of sale. Digital marketing has been an area of focus with e-commerce business showing a lot of promise and the recent spike due to the COVID. On the kids wear business, we continue to, it continues to be our focus area with very encouraging customer acceptance and feedback. Out of the 60 stores which we opened, the EBOs which we opened in this quarter, 10 of them were the junior EBOs, and all of them are, have started doing pretty well, taking the total number of EBOs on the junior side to 15, 15. We have also appointed all the distributors in the for the jockey business, for the junior business across 50 cities as phase 1. They will be shortly moving to other cities as a part of phase 2. We continue to work on expanding our width and depth within existing market geographies, as well as strengthening our distribution in tier 4 cities and rural areas. We see a great potential in these markets, and we are strengthening our distribution network in phased manner in these opportunity markets. Jockey currently is present in 2,870 plus cities and towns across the country. We will, as usual, continue our focused approach on all our core business verticals of men's innerwear, women's innerwear, athleisure for both men and women, and socks and towels. And we are quite confident of maintaining growth going forward. With that, I will now request our CFO, Mr. Chandrasekhar, to take you through the financial highlights. Thank you.
Thank you, Veji. I welcome you all to the Q2 page earnings call, and I wish you all a very happy and prosperous Diwali and festive season. Q2 has been good for us, so it has been a very good bounce back in Q2 as you've seen the numbers. The Q2 revenues have been up by about 160% at 7,403 million, and we are only marginally down by about 4.5% on a year-on-year basis. The revenues for H1 are down by about 36% to 10,251 million because of Q1, as you know. The Q2 PAT is up by almost 380% to 1,109 million, which is almost at par with the Q2 of last year, and the rate change of 25% retrospectively last year in Q2. We would be almost at par with it. So it's a very strong bounce back. The PAT margin also at 15% is one of the best we have in the past few years, and that is because we have implemented a very tight OPEX control which is zero based, and as MD was saying, it is based on need to spend and being frugal about the times we are living in. As far as the first half, the PAT has become positive. We have come to 713 million. And the margins, the EBITDA margins are strong. Similarly, also the gross margins are around the 40% mark, which we have delivered in all the normal quarters in the past. And more importantly, if you've seen the earnings presentation, some of you may have gone through it. The cash and cash equivalent has increased by almost nearly 488% to 4,013 million. And again, this is because of pretty efficient working capital management and OPEX controls, while also at the same time supporting all the business ecosystem, paying all the vendors ahead of time if required. So we've done pretty good work in the past 2 quarters to get here, and our balance sheet continues to be net debt free, and we again haven't borrowed any funds in the first 2 quarters. Net working capital is 5,361 million, and it's again because the inventories have come down from a level of almost 7,186 crores at March. We had now 5,718 million, in September. So these are the financial highlights, and we can move on to the Q&A section, please.
Thank you very much, sir. Ladies and gentlemen, we will now begin the session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. We also request the participants to please strictly limit their questions up to 2. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Thank you. The first question is from the line of Bhargav Buddhadev from Kotak Mutual Fund. Please go ahead.
Yeah, good evening, team, and congrats for the good set of performance. Thanks, Bhargav. So my first question is that is it possible to share trends in secondary sales? How have they been, and also has there been any sales loss on account of any supply constraints during the quarter?
So yes, in the earlier part of the quarter, we had some constraints, but coming towards the end of the quarter and now going for the third quarter, we are pretty fine. Because as I said in my opening remarks that 95% of our people are back and our factories are running in full force. So that's not a problem. As far as secondaries are concerned, it's been one of the best years for secondaries in that sense. Our secondaries have been ahead of our primaries all these months of the quarter.
Okay.
So just want to clarify one thing. Did I hear properly that you said FY22, FY21 will end up flat over FY20? Meaning, are you looking at full recovery? Is it what you said?
No, what I meant was that, as I said, from quarter one where we were almost 25% of the quarter, and we have moved to the situation. We're saying by the end of quarter four we should be back to, basically coming back to the normalcy and trying to match the numbers of last year. But whatever has been lost cannot be.
Okay. And lastly, so the yarn prices have started rising again. We are hearing that they're almost up 10 to 12% in a month. So are we looking at taking any price hikes in order to pass on these yarn prices?
No, we generally take care of this any kind of surges in advance, and we have already done what we have to do for the year. This is also because this is the old crop. The new crop is around the corner, and as soon as the new crop comes somewhere towards the December, January, the prices will soften again. This is a normal phenomenon which happens almost every year.
Okay. And lastly, on the kids front, is it possible to share how many outlets are we now present? We have total of about 67,000 outlets. So what is the coverage area for juniors? And that will be my last question.
Yeah, we are closely touching close to around 8,000 stores for the kids now.
Okay.
All over. And as I said, we have opened 15 EBOs for the kids as well during this time.
Great. So all the best, and also very happy Diwali.
Thank you very much. I wish the same to you.
Thank you. The next question is from the line of Aditya Saman from Goldman Sachs. Please go ahead.
Hi, good evening, and thanks for your time. So, firstly, in terms of the guidance of sort of normal sales by 4Q, I would have assumed that we'd reach much higher sales numbers given that we are already at double-digit growth in September. Is this because there was an evidence of pent-up demand that came through in September, given that we had obviously a meaningful decline in 1Q? And then on a related question, was there any also were the September numbers skewed, September or October numbers skewed because of the supply constraints earlier in the quarter?
So as I said earlier, the earlier part of the quarter, it was still sort of reeling under COVID, and there were still many large cities which were under lockdown. So that was primarily the reason for and as I also said in my earlier replying the earlier question, we are also sort of getting our feet right in terms of production in the month of June and July, and post that, August and September, it's only improving. And the sales are continuously, on a rising trajectory from the month of August, and we are also seeing that, going with the same pattern into the festive season. So it's not the pent-up demand; it's the actual demand which was there but got subdued because of obvious reasons.
Yeah, no, I understand that. I think my question was, look, I mean, if a consumer was looking to buy a pair of innerwear or athleisure in May and he couldn't buy it then, I'm assuming that same customer, you've not lost the customers. The customers come back and made that purchase whenever the stores were opened in July, August, September. Is that why you're pushing your normalization to 4Q? Why not have double-digit growth in 3Q itself?
No, yeah, sure. Why not? And that's what I was trying to tell you, because the trajectory of the sales has been only upwards post-August. And, since I cannot tell you the numbers for the third quarter, but the trajectory is still on the upswing. So probably what you're saying is possible.
All right. Understand. Very clear. And secondly, in terms of, you indicated that there's about 13.5% volume decline and the sales decline was about 4.5%. Now, this gap, is it largely mixed because you sold more athleisure, or is there an element of pricing in that as well?
So it is definitely a mix, within the innerwear also, because we also have premium and super premium products in innerwear. So there is a mix change there, as well as athleisure. As I've been telling you, in this year, athleisure has taken a front seat, and we have got pretty good demand on the athleisure side of the business.
No, thanks. And just a quick follow-up on that. So any sense you can give us on what the growth for athleisure has been, say, in 1H or 2Q, whichever way you want?
It's a double-digit growth. We don't talk about the actual percentages, but it's a double-digit growth for the athleisure business.
Fair enough. I'll come back in the queue for more questions. Thanks.
Thank you.
The question is from the line of Nihal Jham from Edelweiss. Please go ahead.
Yes, sir. Thank you so much and good evening to the entire management. Sir, a couple of questions from my side. First is on our cost-saving initiatives. If I look at how the spend has moved to last year, there has been approximately a 10 crore reduction in other manufacturing expenses. So would it be right to assume that most of the incremental 30 crore reduction is driven by sales and marketing? If you could just elaborate a little more on that.
Casey, would you like to?
Nihal, thanks for the question. Yes, there's a lot of work which has gone into the manufacturing overhead, mainly in terms of the factory overhead. And also selling and marketing, we did spend a little less on the advertisement by about 172 million this quarter as compared with last quarter. Overall, there has been a reduction of about 450 million if I take all the line items of selling, corporate, and manufacturing. So the reductions have been across the board.
Sure, sir. I think that's helpful. My second question, sir, was on the expansion part. As I see on the EBO side, you mentioned you've added 60 EBOs in this quarter. Just on the MBO count, that's been constant at around 67,000. So I just wanted to understand that on the MBO side, is it that we look at adding more MBOs after this quarter, or that number you think will be around the similar trajectory for the remaining part of the year?
No, we, as you know, we constantly push that number between 5 to 10% year on year. So this year has been a little unusual for us, and we've not been able to open many more stores as we would have opened by this time. But I think now quarter 3 and quarter 4, we should be opening more stores on that side, and a 4 to 5% increase in stores is something which is pretty normal, and we will continue doing that.
Sure. And just very quickly, you mentioned about the secondary sales trends. Is it possible that you have a visibility of the tertiary sales also, and if those numbers are similar to the numbers we are tracking? And that will be it from me.
So we have visibility of tertiary sales in our own EBOs.
Yes.
So we do not have it for the MBOs. So yes, it's keeping pace. The tertiary and the secondary sales, have been quite buoyant and starting August onwards.
That's helpful, sir. I'll come back in the queue and wish you all a very happy Diwali. Thank you so much.
Thank you. Thank you, Nihal.
Thank you. The next question is from the line of Arnav Mitra from Credit Suisse. Please go ahead.
Yeah, hi, and thanks for taking my question. My first question was on the e-commerce part of the business. What is the current salience that e-commerce is having in the business? Are you seeing the traction there continuing despite the lockdown kind of now fully gone? And any changes you have made on your side in terms of being able to service the demand better, give the entire range, and reduce the lead time?
Yes, Arnav. So I think that's the silver lining of this, this year, which has pushed us so badly on all other trends. E-commerce is one area where it's really helped the business on that side. As I said in my previous call, there was a certain amount of struggle in the previous quarter because the demand on that side was so high, and we had to really work on our infrastructure. It took us around 1.5 months to put up the relevant and required infra for the new demand, and we have seen now that the demand is close to around the average demand has gone up by 2x. Though initially it was almost 3.5x of last year. So it seems to have settled down at around 3.5x of the average we used to do on the EBO side. So on the e-commerce side. And as I said, e-commerce we have 3 different. We have our own store, which is jockey.in, and then we do outright, and then we also do marketplace. So the outright and the marketplace also has seen a huge growth during this time. So we see this is a positive welcome change, and so we are also gearing up the infrastructure further to sort of offset any demand increase going forward.
Sure. And my second question was on margins. So other than the 17 crore reduction in ad spend, which possibly could come back as the festive season begins and business normalizes, would you say that the rest of the cost savings or the margin expansion and the cost from lower cost that is sustainable, and therefore you are now going to be consistently in that historical margin band of 21-22%, which you were till a couple of years back?
Yeah, that is the work expectation and the work that we are putting in, and we are not increasing on the current spend without that bringing additional revenues or cost saving. And secondly, in terms of whether the margins will sustain, the answer is yes. We already have shown good margins in Q2, and also going forward, there will be definitely some increase in spend on advertisement. Secondly, on the digital transformation, head back a bit this year. So those investments will come, but they're all productive sort of investments into the future of this business.
Okay. Thanks. That's it from my side. All the best.
Thank you. The next question is from the line of Avi Mehta from Macquarie. Please go ahead.
Hi, sir. Sir, we understand that urban continues to remain under stress. You had highlighted that kind of had weighed on our performance versus peers. Is that something that is still continuing, or has there been an offsetting factor?
No, sorry, could you repeat? I didn't get your question.
So what you had said is last quarter you had said that we were impacted more versus peers because of our urban salience. Almost 60% comes from the top cities. Given that what we understand is urban continues to be under pressure, what has that trend continued, or there has been some offsetting force which has kind of helped to counter that?
No, we have come a long way since the quarter one. While there are certain pockets in the metros, what I said last time is close to around 38-40 cities, which gives us that number. And obviously, the bigger number was coming from the metros. Now, most of the metros are actually back, barring Bombay, which is still not at its what it should be. But besides that, most of the metros are back, including Chennai now. So we have come a long way since that.
Okay. So that no longer remains a headwind, which was.
No. It's still slightly lower, but it's not something which would impact us anymore.
Perfect, sir. And sir, the other, where there was a provision that we had created for slow-moving inventory in the first quarter, have we written that back in this quarter by any chance, any part of it? And related, if you could just explain the slide on the gross margin, what all goes into the other expense, other manufacturing costs, and how do we look at that? Those two would be
Yeah, Avi, good question. Slow-moving inventory still continues. It hasn't come down greatly. Okay. But as we go into Q3 and Q4, all the slow-moving inventory will get sold. So it will definitely come down. As far as the gross margin, based on some of the discussions in the last quarter, I've given because people tend to read contribution differently. Other manufacturing costs has wages. It has all the factory overhead like power and fuel and all those things which you need to run a manufacturing unit. So we typically only look at gross profit margin. And I have been saying that we have been in the band of 39 to 40% all through history, and so that also has come back. First quarter, as you know, was an exception.
Perfect, sir. And if I may, just a bookkeeping question, sir. Was there a price increase? We had indicated, price increase was taken in few products. Any weighted average price increase that you could share? And the other income, do you expect that to, it's more a timing impact because your cash levels have gone up very sharply. Congratulations with that.
There wasn't any significant price increase. It was only an adjustment for some of the underpriced products. Veggie will explain to you that. And what was your second one?
So the other income has dropped QOQ.
Other income is because we had this quarter we didn't get subsidies what we got in the Q2 of last year. So that is more a timing issue. So it's not a significant difference to the bottom line anyway.
The mispricing, Vijay, what was that?
Yeah. So Avi, as I said even in the last meeting, see, we generally work on a weighted average EBITDA. So there were these few products which we felt were way below the minimum expected EBITDA, and those were the ones which we had touched somewhere in the month of June. So that was the which I explained even in the last time, and it was a few products here and there within across all the ranges. So it's not the regular one which we used to do. Like most of our products used to get touched once in a year. So this was more from the point that they had to have some kind of basic EBITDA to be in the reckoning. So those ones were touched. So it was a very small increase this year.
Okay, sir. Wish you a happy Diwali, sir, and thanks a lot again.
Thanks. Sir.
Thank you. In order to ensure that the management is able to take questions from maximum participants, we request you to please restrict your questions up to 2. We move to the next question from the line of Sameer Gupta from India Infoline. Please go ahead.
Hi, sir. Thanks for taking my question. I have just 2 questions, sir. So, we are seeing double-digit sales growth in September, and that trend has continued in October. Just wanted a little more color on this, sir, because even before COVID, we have not seen such strong demand tailwind. So, is it also to do with people spending more time at home, and there is a conversion from formal wear to athleisure? People are spending more on athleisure versus formal, and when this trend reverses, as in people start to go back to offices, this trend should also normalize. Any color on that? Maybe segment wise you can share, because you said athleisure has grown at double digits for the quarter. That would mean that double digit declines in innerwear for you. Is that understanding correct?
No, Praveen.
Hello.
Hello, Praveen. Can you hear me?
Yeah.
We cannot, as a company, have a double-digit growth if only one of our verticals of business grows with double digits. So everything has to grow to grow overall at in a double-digit percentage basis. So having said that, both our innerwear as well as outerwear have grown during this period. Athleisure, yes, it's grown at a higher percentage for sure. Coming to the second part of your question, whether this is a trend which is just for some time and then when the work from home finishes, we don't think so, Praveen, because it's also created a lot of trials. There are a lot of people who have tried the jockey products for the first time, and as we know from our experience from the past, trying the jockey product, whether it's innerwear and outerwear, when we started way back with innerwear. And the stickiness to our products is very, very high. So once people try and they see they see the quality of the product and they see that the kind of value for money they are getting on their purchase, we see that this trend is going to only grow bigger, and because this market is also ballooning and growing year on year. So I think this was the silver line was that we are able to create many more trials during this year.
Got it, sir. That's very helpful. Just another question, and this is related to your gross margin calculated on the cost of goods sold that you report in your results. So I see that from 1Q to 2Q, there is a sharp increase in my gross margin, and that was largely a drop in 1Q that we had seen. And also, we had taken an inventory write-down of around 107 million in 1Q. So in 2Q, is the improvement partly because there has been any kind of reversal in this provision, or if not, then what is actually driving this QOQ margin improvement?
There is no reversal in provision for inventory or anything. It's a purely operational, the COGS which we report and the gross margin and contribution are as it appears in between the goods sold and the revenue. So there is no unusual impact in the margin of this quarter.
I am actually comparing, sir, versus 1Q. So versus one.
Compare first quarter, because first quarter is unusual, and the fixed, the labor cost, everything is under absorbed. So that reflects in your contribution and gross profit margins. The first quarter is really not comparable.
And sir, as this new crop comes in, this input prices should see some more softening, and to that extent, our margin should see some more increase from this level. Is that understanding correct?
We have actually seen in Q1 about -3 overall weighted average cost improvement in the raw material. But when we go to Q2, we didn't buy much in Q1 because of the lower sales and we had inventory. So we didn't capitalize on that. When we went into Q2, we had about 0.53% increase overall on a weighted average based on the consumption mix that we do. So we don't anticipate any great. If at all there is an improvement, yes, it would improve the P&L. Yes.
Great, sir. Thanks a lot. Thanks for answering all the questions. I'll come back in if you have any follow-ups. So I wish you all a very happy Diwali.
Thank you, Praveen.
Thank you. The next question is from the line of Mihir Zaveri from Analysts Capital. Please go ahead.
Yeah, thank you for the opportunity. Just one clarification, sir. Sir, you said that basically September, again I'm repeating that the September has been double digit. So basically is it fair that if the run rate has been much better than you can see in the second half, we can see a decent double digit growth? Is it fair to assume that way? Was that the kind of a guidance which you were trying to give? Just that clarification, sir.
See, what I was trying to say is the trajectory starting the month of August has been on an upswing, and it has continued throughout, and especially with the festive season around, it continues to be there. So we're quite hopeful that we could do much better going forward.
Fair enough. Okay. Thank you, sir. Thanks. That's it from my side.
Thank you. The next question is from the line of Bharat Shah from ASK Investment Managers. Please go ahead.
I don't have a question for this quarter, but a little broader discussion. So as an observer and investor in Page Industries for more than 10 or 11 years, growth has relatively been easy for Page, except some occasional periods of irritant, but generally it has been smooth and easy. Prior to pandemic, if we see, the previous 2 years have been mired with number of challenges, maybe some external, some internal. Externally, things have been softer for the economy. Internally, maybe with the relentless growth, we might have been a bit more self-satisfied. Since in this 2-year period, what I have observed is that there has been a significant effort to improve the character of the business, to prepare for a capacity of the business to improve going ahead. So technology initiative, business transformation, product portfolio revamping, people hiring, etc., and the design capabilities. Can we say today, with all that has happened, plus maybe whatever internal issues that we may have needed to deal with, are we today willing to, are we saying that we have crossed the hump and hopefully in some time we should be ready to resume more akin to what Page we have seen earlier in terms of the growth, because eventually growth is the way of life. But I'm delighted about two things in these 2 years of tough time. One, we maintained the discipline of the sales. We did not surrender to cheap sales by easy credit and all those kind of things which are easy to do. So we kept it tight. And I'm really, really delighted. And secondly, that we kept a discipline on raising the cash flow and the working capital tightness. So are we going forward over 3 to 5 years, finally the difficult phase is behind?
Mr. Bharat Shah, thank you very much for your observations. We know that you have been very closely
following our company, and you have been our shareholder for a long time. While you know what happened in last couple of years, and we have discussed on these forums many a times. I would say yes. I think we have come a long way. So these 2 years also have helped us to put a lot of things and a lot of new interventions put together to help us to grow towards that vision of 1 billion in next 4 to 5 years. We strongly believe that we are in the right place now to go for it, especially these first quarter where all of us had ample time to put our heads together and plan first this difficult year and then the way forward. I think we are all poised and ready to take the big leap forward, Mr. Bharat Shah.
Okay. So which means the future is looking superior than these 2 difficult past years. I'm not particularly concerned about this pandemic period. That's unusual, so that can be left out from the calculation. But the future is now looking, can we believe that remarkable, much superior than these 2 years have been?
I would very strongly believe that, sir.
Okay. Thank you. All the very best.
Thank you very much.
Thank you. The next question is from the line of Akhil Parekh from Elara Capital. Please go ahead. Akhil Parekh from Elara Capital, your line is unmuted. Please go ahead with your question.
Yeah, sorry. Can you hear me?
Yes, we can hear you.
A little closer to the phone, sir. We are unable to hear you.
Okay. Many congratulations to the management for a very good set of numbers. I just have 2 specific questions to Mr. Jinomal. One is, you have mentioned that our internal target is to reach a $1 billion sales target. Any external or any internal steps that we are taking to accelerate the sales growth rate? That's the first question. And second is on the audit which was taking place in regards to the Norges Bank issue. Any update on that would be very helpful.
Well, yeah, sure. So in terms of the what we're doing to accelerate the growth rate, that's something that's ongoing, right? There has been no relenting. We don't leave any stone unturned, whether it's innovating or refreshing our products or our marketing, our visual merchandising, strengthening our sales force, all these. That's ongoing. That's unrelenting. We never stop doing those things. In fact, all our time is consumed on how we can outperform and outdo ourselves in every respect. So that's something that's always ongoing. It's we know. As I said, we're very confident about the India growth story. We know that's very much intact. We of course have this $1 billion goal that we are hopeful that we'll be able to reach. It's not a big ask from our calculations in terms of what we feel the market size. And I think as long as we continue to strengthen and take full advantage of the platform that we are in, I think we are very, very we're in a sweet spot to take advantage of that potential. So all these things I mentioned in my opening remarks are things that we've been doing, we are continuing to do. That's important to remember. It's not like we're just starting now because of COVID or no. These are things that we've always been doing, but yes, we keep on refreshing and reinventing ourselves over the years. Our strategies remain steadfast to our strategies, but obviously obviously they continue to evolve. But the essence remains the same. Our fundamentals are very, very strong in the back end and the front end. It's something that we're very proud about, and we are going to continue doing all that. No let up and no stone will be left unturned to continue trying to accelerate our growth. On the other question of just to remind everyone, the background is, just to give you a perspective, we have about 15 manufacturing and warehousing locations employing around 17,000 people. The issue that you referred to by the Council of Ethics Norway pertains to one of our units in Bangalore, where we employ approximately 1,000 people. And these allegations were made in 2018 by a handful of disgruntled employees to the council. And so that's the long and short of it, of what happened. So a few weeks back, we have engaged with the council. We had very cordial meetings with them, in fact. And we provided them, very objective point-by-point evidence, which we believe, flatly disproves the allegations of the report. Because no such things happened, what was alleged. So the council has appreciated our response, receiving our response, and they've confirmed that as per their policy for reassessment, because we asked for a reassessment, that they would have to do an independent audit of the facilities themselves at the earliest possible time. So we welcome that because we wanted them to see themselves what we are all about and not listen to some third-party allegations. And so COVID permitting, they've said that, probably around middle of next year is when they hope that they will be able to come and do a reassessment. And we, in fact, told them to try and do more than one, do 2 or 3 factories to get a flavor of what our policies and our systems are like. We're hopeful that after they do that, it will be a positive outcome, and that will happen after that reassessment. Meanwhile, you would have heard that GRAP, which is a worldwide responsible accredited production, headquartered in USA, has conducted a very rigorous inspection of that unit referred to in the council's report, and in the month of October, on the 20th or 21st, 22nd of October. And they're very satisfied with the state of affairs of the unit. They actually investigated point by point all the allegations made by this handful of employees to the council by interviewing quite a number of people, close to 100 people, picked at random, sampled from various departments, and they have indicated to us that they tried to dig and tried to get information, but that wasn't coming out. All those allegations, none of those allegations was coming out. So basically the truth has prevailed, and they, in fact, we are expecting a certification of compliance for that particular unit from them in the coming week, which we're going to post in our website.
Sure. Thanks a lot for a very detailed answer. I wish you and your entire team a very happy Diwali.
Thank you. The next question is from the line of Raj Motivana from Nivalis Partners. Please go ahead.
Good afternoon, good evening, gentlemen. This is Ayaz. Thank you for taking my question.
Excuse me, this is the operator, so we are unable to hear you. Can you speak a little closer to the phone?
Yeah, I'm right at the phone actually. Is this better?
Better. Yes,
yeah, better. Yeah, thank you. And I'm sorry about that. So you've had a very detailed presentation that you put out, and you have been putting it out for a while. I would like to get the breakup of your revenue across men, women, kids, and athleisure in your core innerwear business. If you can share that. And my second question is linked to this breakup?
As we used to do this earlier, it's been around 2.5 years now. We have stopped giving this breakup for obvious reasons, because this was sort of not helping us but helping a lot of people who are trying to compete with us. So we are not giving these breakup details anymore. Sorry about that.
Sure. No, so the reason I asked that, and as Mr. Janumal also has brought out that you are ready for the opportunity, and in your presentation you brought out, the gross market opportunity across each of these 4 sort of verticals, which which talks of an opportunity size of probably a 1 lakh crore plus market. My focus is only on the women innerwear side of the business, where you open some exclusive outlets. And that market is obviously much larger, as you pointed out in your presentation. So my question to you, sir, is as we reflect on the development on online and your EBO experience, do you think you have found a formula to be able to crack open the women innerwear market, which from the past numbers for you has a much lower contribution, while the market size is much larger? And if you can expound on that, please. Thank you.
Yeah, thank you. The points you brought up are absolutely correct. The women's market is larger in terms of the revenue size, and also the number of pieces for obvious reasons, because there are bras and bras has also many SKUs in terms of size and cup sizes. And then also the usage of panties is much higher as compared to innerwear and men. So absolutely right. We also understand that our penetration levels are quite lower. Our understanding is that while our penetration levels in the market what we cater to, the segment of market what we cater to, while it's 19 to 20% on the men's innerwear, it's only 5 to 6% on the women's innerwear. So yes, you're right. We have a long way to go there. The response from our EBOs, especially the EBOs for women, has been very clearly reflecting on the fact that if we have the right products, and especially with our value for money proposition, there is a huge market. And so we have some plans which I may not be able to open up currently, because they are still to be worked upon in terms of execution. So we have some major plans going forward for the women's side of the business, because we understand the headroom is very, very large, and we need to do a lot of work on that side. And we are working on it. While we are passing this year, we are also working separately on a separate focus, both while we already have a separate focus on the product side, which is on the back end. We have some plans to create a focus across the vertical, coming from starting from the product development to actually to the sales. So there is some work happening on that, and probably I'm sure you will see we'll be having much more faster inroads into this market in the future coming years.
Sir, my last question is just on the new product launches. That is a slide which you put out, slide number 18, and they seem to be quite impressive products. And a larger focus, it seems, is on the day wear or athleisure, as it's called. So is that a big segment for your business right now, and also growing very rapidly?
Yes, that's what I said earlier. It's relatively the largest, after the men's innerwear, this is the second largest in terms of percentage contribution. So it's a large business for us, and we also see that there's a huge scope, because this market is growing very fast, especially with all the gym wear and the yoga wear which we are working on right now. And the kind of ranges which we have, when we say athleisure, it's a mix of athletics and leisure. So we are focusing on both of these, and these are very core products, and they do not go out of fashion. We also have some ranges on the performance side, which is called Move, which is in the markets and doing pretty well. These products are something what you see the Nike Dry Fix. These are comparable products.
at probably 60% of the prices. And they are available in the market, doing pretty well for us. So there is a huge scope there, and I think this year has, as I said earlier, helped us to create a lot of new trials, and we're very, very bullish about this side of the business.
Great. So thank you very much, and I appreciate your time. All the very best, and happy Diwali to the entire team. All them.
Thank you. Same to you and your family.
Thank you. The next question is from the line of Ankit Kedia from Phillip Capital. Please go ahead.
Thank you for the opportunity. Sir, in the initial remarks, you mentioned around the digital transformation. Can you emphasize more details? How will that help us at the back end? Because on the assortment generator, I believe that you are implementing JBA also by December, and also at the warehousing we are doing full fulfillment with DHL. So some input could be helpful.
So all the automation what we have been working on. So the whole idea is to create a seamless supply chain, which starts from the basic understanding of what we need to sell, and then eventually having those products ready in our warehouse before the day we want to sell them. So to have this whole process in place, so we are starting with, as Mr. Dhanawal said in your remarks. So JDA is one of the tools which will help us to plan through all this, which is basically creating the demand tool, and then eventually actually putting it into the SAP for having the production done for the same demand, which is created by this tool. Then going forward, we have the distributor softwares where the DMS, which is the distribution management software. So once the goods leave our warehouses and reach the distributor management software, the whole idea there is that we have a very clear vision about understanding about what the stock is at the distributor, which is further linked to the ARS, which is the automatic replenishment system, which basically joins the distributor stocks with the paid stocks, so that as and when it comes below a certain level or the tank which has been defined, there's an automatic order which is raised from the distributor and supplied from the paid warehouse. And for the tertiary sale, there is SFA, which is the sales for automation, which basically is helping us to get the orders from the market and to be billed in the real time. So earlier, in the past era, all the orders will be collected by the day end, and then the next year the billing would have happened. So today, all the orders which come before 2 o'clock get almost delivered on the same day by the evening. So the whole idea is to basically create a supply chain where we can see that there is zero sales loss, and the consumer gets what they want, whether it's an MBO, EBO, or an LFS store. They're all getting linked with this technology to help us to have this seamless supply chain.
Excellent. That's helpful, sir. So my second question is on your capex part. With the 1 billion revenue plan, what kind of capex would we need over the next 2 to 3 years? And can we expect the Anandpur facility to come in Q4 on stream?
So, I will leave the second part of the question for our CFO. So we are actually going ahead with our Odisha plan first. We will be starting that very soon. The activities there, it got a little delayed because of the COVID. So that is something which we are going to work on. It's a very large facility which we're going to create there in Odisha. It is a place near Bhubaneswar. And then eventually, we may come back to the Anandpur. That's not decided as yet. On the capex part, I would request KC to.
Yeah, thanks, Reggie. So far, this year we haven't planned any specific capacity expansion exercise. Still, we will be spending close to about 730 million this year, though in the first half we've only spent about 80 million. So the rest will come in the next 2 quarters. When we are going into next year, we haven't firmed up the plans for FY22 capex yet. But if there is capacity expansion, it is roughly about 2,000 million, including all the normal capex and the capacity expansion and the digital transformation put together.
So just a follow-up, what's the logic of going to Odisha? We have always been next to Karnataka, India, and around that region. So why did we select Odisha now?
So we also don't want to have all eggs in one basket. That is not everything in one state, because when we are growing, we have to reach the other parts of the country as well. In fact, going forward, we may have even warehouses in different parts of the country, especially something in north, to reach the consumer faster. Because everything is getting done from one place, which we felt from long-term perspective and risk management to have presence in a couple of states, to have predominantly from the risk management point of view.
Sure. And sir, my last question is on the women's side of the business. Can you tell us what is the total retail reach we have in women's compared to men's in terms of the stores?
It's close to around 40% of our total number of stores, 45% to be precise.
Sure. That's helpful, sir. Thank you so much.
Thank you. Ladies and gentlemen, we apologize due to time constraint. That was the last question. I now hand the conference over to Mr. Chandrasekhar for his closing comments. Over to you, sir.
Thanks for attending the Q2 stage earnings conference. So, as always, we continue to learn from you and also during this period. We also appreciate all your questions and thanks for your continued support for Page Industries. Happy Diwali to all of you. Have a great time. Bye-bye.
Thank you. Thank you, members of the management. Ladies and gentlemen, on behalf of Axis Capital, that concludes this conference call. Thank you for joining us, and you may now disconnect your lines.